Planet 13. This video is about 16 questions answered by the top management team.
Hi, good afternoon, guys. This is a great quarter. Let me start out with the margins, Dennis. EBITDA margin 27.2% versus 20.2% last year, so 700 basis point improvement. Can you sort of indicate how much of that was due to just increased volume and operating leverage, and how much maybe was due to the vertical integration in your own products?
You know, we've bifurcated it a number of ways, I guess, to get as granular as we can. As we move towards our target 50% of vertical integration, you know, we're about halfway there now, so I would say a good chunk of that margin improvement, probably a little bit over half of it, has come from that vertical integration. And then the balance of it is coming from, you know, just the success of the store and the larger ticket sizes and, you know, the return to that tourist customer where we get higher margin business. You know, so our curbside, you know, I guess it's a testament to the fact that we have curbside and home delivery that are targeted to locals, and so those margins are lower, but that lower margin is offset by the higher percentage of in-house products that we're selling through those channels as well. So it's kind of a double whammy on that one. So
what do you think, you know, if you get to your in-house products get to 50%, including, I guess, your own flower, or more of your own flower with the new cultivation facility coming on, and then obviously more scale, what do you think EBITDA margin can get to?
Without having to, you know, continually update that, I mean, we've talked about in the mid to high 30s as where we think it can realistically get to without a lot of additional costs that we have to spend or capex we have to spend. So that's our target.
I noticed that flower represented 61% of sales in the quarter versus, you know, pre-COVID it was in the low 40s. Is that still a reflection of the local? Would it be a reflection of the local traffic in your mix, maybe than historical?
Yeah, that's part of that, because on the curbside and the home delivery, that is the case where the preference from the local customer is more towards that flower market, as you know. But as the tourists come back, they tend to buy the higher margin non-flower products that we sell in terms of our in-house brands. So the margins there are pretty lucrative for us. So, but that mix on the flower side is driven by that local customer for sure.
Right, and so part of that to get to the mid to high 30s, could it even, you know, I guess with more edibles or concentrates, it could help to get there as well. Medicine, so you've reopened. 4.9 million, I think, was the last quarter. Larry said in his speech. Given, I know Nevada's grown, but there's been a number of new stores open as well. Albeit one of your competitors is about a mile away. Did very well in the quarter as well. Can you speak to what your expectations are? Can you match where you were, or do you expect you know, to be more pressured in terms of the competition? And cycling off, obviously, some to the superstore in the past.
Yeah, there's going to be a bit of a ramp up. We expected that. I mean, the store's been closed for 2 years now, basically. The timing on the opening, you know, was a bit longer than we'd anticipated with the regulators. But you know, now we're open. The store is literally continuing to be stocked as we were on this call. So the full rollout and the launch with the advertising and messaging on the reopening really starts in earnest later this week, Friday to be exact. But we're very excited about, you know, what the future holds. You know, since we reopened, we've got a $2 billion stadium down the street from us, and we've got significant improvements to the 215 freeway system that have just finished. So it's easier than ever to get in to our store. So a lot of upside there. I'm confident that, you know, again, with a brief ramp-up period, we'll get back to the numbers that we were looking at when we closed in October of 2018.
Right. Now let me just add, this is Larry, that competitor you're talking about was not a competitor when we were open. They became more successful at that location because we had to move our license. When we're back, we'll take over control of that area just like we did before, and it'll be just as successful as before. Unfortunately, to their detriment, but even though they're good people, it's our location is far superior.
Your corner boys are going to be back. Finally, just on your wholesales in 40 other dispensaries. I think that's about 2/3 of the state's dispensaries. Can you get more? Or is this the 40 best ones, and is now just a question of improving same-store sales at those dispensaries? And how big do you think the wholesale business can be? And I'll leave it there.
Well, I think, again, Doug, it's Bob. I certainly think there's room for additional growth. And as you know, we've got quite a few new recreational licenses will be coming into the market here over the next 12 to 18 months. So there's a lot of upside there. There's no reason we can't be, 2/3 of those stores as we continue to grow. We're excited about that. Our team tells us they're getting very positive feedback from the stores that we're not in, and that they're interested in looking at our product lines. So, they're going to keep pushing, and really the proof is in sales, and they see what's happening with other stores that are carrying our product lines, and they're looking at the sell-through rates. So, a good business person is going to take advantage of that as well. So there's plenty of room for growth.
Just thinking about margins again, but maybe honing in a little bit more on wholesale, kind of curious, where you see those margins going with the additional cultivation coming online.
Yeah, so Bobby, it's Dennis. So the additional cultivation coming online, when we first took it over, we were utilizing some of the flower that was in the facility and the inventory that we acquired as part of that asset acquisition. We pushed that through our own production facility, and so got some great margin enhancements there on our in-house products, using it for the Ha Ha gummies, and et cetera. Going forward, as we move our own strains into that facility, there'll be less opportunity to use the flower. Well, I guess I could spin it the other way. All of the flower that we can grow in that facility will be sold as premium flower in the store, and both at the superstore and the medicine store. And so it's a higher margin game for us selling that flower. We were 8% of revenue coming from our own flower in the second quarter. We should see that kind of more than double to 16 to 20% with the addition of this new cultivation capacity, and it'll be in that premium flower category. So I think the margins will be a lot better than what we were getting just running it through and making our own edibles and concentrate products.
So it sounds like the margin opportunity is really in the superstore, obviously, as you move that premium flower in and get more of your own shelf space with house products. For both. Well, I guess for both that and the medicine store, because that will add. And medicine, okay.
I think we'll sell the majority of our products. I think medicine will be majority of our products in that store, and not as many third party, because it is more of a local market, right? So perfect. And then just curious, with expansion initiatives beyond Santa Ana for similar, large format, exceptional experience stores, what kind of costs are you seeing out there if you had to compare, other metros you're looking at to the kind of costs you've incurred and you expect to incur both in Las Vegas and Santa Ana for building out, large format stores? Are there big kind of ranges that you're looking at in terms of, the cost of land or labor or, other inputs? Yeah, I think the big cost swing, it is a broad range, as you mentioned. I mean, the big issue for us is it an existing operator with an existing storefront that we're buying and then going to move, or do we get a license through another means, or a license from a party that hasn't opened yet? So it's quite a broad spectrum where we're looking at leased land or leased assets mostly. So we're not going to buy land or buy a building, but we lease the building. So we're partnered with a couple of national real estate groups that have primary locations in the markets we want to be in, and it's just a question of how we go about getting licenses in those individual markets and moving them into the locations that we want. So it's going to be a bit of a mix depending on the state and the city we end up in, or the cities we end up in.
Great. So if we start thinking about the growth on top of the kind of 2021 expectations, obviously we would get a full year of Santa Ana in 2022, but as we start to layer additional stores, potentially onto your forecast, how much dry powder really is that $70 million and kind of the cash generation between now and when you might start building things out? Is that, are you using a mix of cash and stock? It seems like a significantly large amount of dry powder relative to kind of the revenue footprint you guys should have organically, I guess, in 2021.
Yeah, I mean, we intend to use cash and stock to get into the markets we want to be in. If we look at Santa Ana as an example of the mix of cash and stock, if we can replicate that deal, then the $70 million in dry powder gets us a significant number of stores. I don't think that we'll get I don't think we'll be able to find as good of a deal that we did in Santa Ana going forward, depending on the markets, because there are lots of competition in some of the markets we're looking at. But suffice it to say, I think we can at least open 4 more stores with the $70 million thereabouts.
And thank you. That's helpful. And is there a lot of emphasis now, being placed on trying to get access to more cultivation assets internally in California going forward? What's your thought on how important that might be over the medium term?
And that's going to depend on the market we're in. Now, if you look at, as the various states have very different supply-demand dynamics in them. A lot of them right now are cultivation constrained. Does that stay the case 18 months from now as a lot of these cultivation facilities come online in the various markets? So it's going to depend. Obviously, if we can be vertically integrated in the markets we go into, we'll go into markets retail first. Definitely have production facilities, extraction facilities, built out, and then in the markets where we think that we need to have that security of supply, then we'll definitely look at the cultivation. So some of the opportunities we're looking at are fully integrated. Others are, let's get in retail only in this state and see where it goes based on what we think the supply-demand dynamics are in those markets.
Great. Thank you.
Regarding the current plans that are underway to double the sales floor to increase the customer throughput during those peak times, like you were saying, how much, I guess, of an uplift in daily transactions would you expect to see there, maybe if kind of all else is equal? And, maybe it would help if you could elaborate maybe on the degree to which you see potential customers maybe being discouraged from visiting or shopping during those peak hours.
Well, this is Larry. Let me answer that. Again, we probably can max out here after COVID. Pre-COVID, during COVID, it's going to max out probably $400,000 only because we're at 50% capacity. But on a weekend when we're busy, we probably can't hit past 450, 475 a day when we're busy, only because we can't get that many people through without having the long lines and the wait times where I hate lines and people just get disgruntled and want to leave. I think with the adding 40 more points of sale, adding another entrance in, another check-in in, which is doing all of those, we then, I think, should max out somewhere between $800,000 and $900,000 a day on our busiest days, the Fridays and Saturdays, once we get all the tourists back and everything going on. We know we have to do it, or we will be hitting the wall. We were just expanding so much, even with COVID, we're still expanding. Can you imagine when this COVID is over? And again, we're just hitting less than 3% right now of the tourists that were coming to town pre-COVID. Less than 3% come here. If we even just double to 6 when COVID's over, we will definitely need the double the dispensary. I can even see in the future that if we continue to grow that way we were going, and people keep advertising themselves on how well they love the experience here and the shopping experience and the whole situation, the entertainment complex. I could literally almost see us taking half of the site and maxing out probably with the grand hallway at almost 60,000 square feet. That's, again, long-term dreams. I'm always optimistic, though, about it. And but we'll start with our first expansion, see how it goes, and I think you'll see us enlarging again here shortly.
I sorry if I missed this, but I think you said it was the estimate of kind of the breakdown of tourists versus local this quarter. I guess just kind of rough estimates there. And then Also kind of wondering, I know the medicine store heavily skewed towards locals. Just kind of wondering what transaction sizes compare with the superstore versus medicine, and maybe what the exact breakdown is in terms of the customer split in terms of locals and tourists. Just trying to get a better sense of what that potential uptick in traffic would look like once travel resumes.
Well, hey, Greg, it's Bob. Let me jump on this, and then Dennis can fill in the details if necessary. But pre-COVID, we were probably doing about 85% of our customers were non-Nevadans. So, since the latter part of March when we closed, we've really seen that reverse. So I would say, roughly 85% of our customers are now locals. And even more so in the last couple months here this quarter, and now with the governor's recently announced pause, a lot of the major casinos on the Strip now are open 4 days a week. And now we've got additional lockdowns with clubs. The fourth quarter's historically been slow in the town, but it's been historically slow now with COVID and, with that transition. But I believe, as does Larry, once this lifts, and we're excited, we think, by the second quarter of next year, things are going to open up considerably. We're going to see that rush. There's a huge pent-up demand. And we know, and we're very confident with that expansion, we'll be able to service our customers and all of our customers. So with medicine, it's a little different. We just reopened it a couple nights ago with a soft opening. It's going to be a little different to give us a little bit of time on that. But if you look historically at what the average basket size was there, considerably lower than what you would have at the superstore. So I put it in the $75 range probably. From a historical perspective, I'm not quite sure where it's going to come out now. But again, the location is fabulous, the facility is fabulous, and the product lines that we carry are outstanding. So, we have every reason to believe that storage is going to be very successful again.
Great. That's helpful, Bob. Last one for me was just kind of relating to the go-forward cost structure. If we think about maybe the superstore being pretty well represented in Q3, minus the, I guess, upgrades that you're currently making, how should we think about what the addition to operating expenses that'll come out of medicine will look like, which are opening this month? I mean, what should kind of the run rate be there? I was just kind of wondering what the cost structure will look like once we add in the medicine store on a go-forward basis here, in terms of the OPEX that will add to where we're at right now with just the superstore.
Yeah, so I guess from a third quarter perspective, we added a lot of people, and obviously during Q2 we didn't downsize as part of COVID. So I don't think, our OPEX is going to be that much higher than it was in Q3 with the addition of the medicine store. We've been paying the lease the whole time. We've been paying, the fixed costs in that place. The OPEX, we're going to move people, and we have started scheduling shifts of bud tenders, et cetera, over to that location. But the overall OPEX, I don't think you're not going to see a big increase over Q3 to get that store up and running and flowing through. Obviously, we can stock it from the products we have in-house as well as third party. So I don't think the operating costs are going to be that much higher to run that store than what we're seeing now. In fact, I think if you look at the margins in that store they'll definitely be better than they were back in when it closed, because we're seeing the average ticket sizes from the local customers at both the superstore and through the home delivery, significantly higher than they were at the medicine store previously. And so with the different events that we think will happen in the Allegiant Stadium and in and around that neighborhood, I think we can see some big numbers on certain weekends coming out of that store too with really good margins.
Real quick, can you provide a little more in-store metrics when compared to pre-COVID as far as what's really driving the growth as far as volume and transactions, or versus the average ticket size going much higher? Can just comparison from the pre-COVID levels to where you're at now?
Yeah. So Scott, it's Dennis. So before we shut in March for COVID, we were looking at in that $100 to $105 average ticket, and we're averaging kind of 60,000-ish customers a month. And then post-COVID, we've seen that ticket go to $125 for in-store, customers falling down into the the mid to high 50s. So definitely the volume is not there in terms of the customer throughput that it was pre-COVID. Part of that is because of, as Larry talked about earlier, we just can't get the throughput with the 50% operating capacity that we have to abide by under the COVID protocol. So if we can double the size of those registers, I think we can get back up to that 60,000 type of customer traffic, and then the $125 average basket in the superstore, I think, is pretty solid. Our delivery and curbside model, which is local customers, you're seeing that average ticket size in the $100 range. So still significantly above the $69.70 that we were experiencing in October 2018 when we shut the Medizin store. So I think the ticket at the Medizin store will be somewhere between $70 and $100 on average.
I appreciate that color. And just real quick on your cultivation expansion as far as capacity in serving the Nevada market, if we have new dispensaries coming on board, kind of how much capacity you have for your own superstore and Medizin versus the wholesale side, and is that enough capacity as you look out from the wholesale, looking out 2 or 3 years from now?
So the current facility as it stands, we can double it. So it adds about 15,000 square feet of canopy at that new facility in the 25,000 square foot building, and it's a 40,000 total square foot building. So we can get another 15,000 square feet of premium indoor grow out of that new facility. With the two facilities operating, I think at least for the next 18 to 24 months, we'll see our ability to satisfy our internal sales of that premium flower in the superstore is where all that flower is going to go. So I don't see us really wholesaling any flower to third parties. What we do right now, given that our current, prior to the acquisition of this new facility, we had 15,000 square feet of grow. All of that flower was sold as premium flower in the superstore, and we purchased third-party, kind of B and C grade flower and trim on the market and push it through our production facility to make our own in-house brands in terms of the edibles and concentrates. So I think that's going to continue. We still get decent margins out of those product lines because obviously we're making them ourselves. We have our own brands, and we get the margin pickup there.
With the momentum of new states coming on board here, what's the biggest kind of drawback or hold up for moving forward in new states and finding those licenses there? What can accelerate that, or what's the hold up currently right now?
Yeah, I mean, as we discussed before, I think I'll let Bob and Larry, add on, but I think it's our ability to find the license in the location that we want to be in. We're having challenges in certain markets with we can get a license, but can we move it from store A to the location we want it to be in? That's where the challenge is right now. So it's a local political challenge that I think, at least based on what I've seen. But Bob and Larry, I'll let you expand on that.
Well, this is Larry Scheffler. I'll add a little bit to that. We want to do what we've done in the past and why we think we've been successful. We spend this money like it's our money, even though it's public money. So if it's not a good deal, as when we are both entrepreneurs, Bob and I, if it's not a good deal for us, it's not a good deal for the corporation. We want a good deal. We don't just want a deal. And we're going to continue to do what we've done the best and wait for the right opportunity. Just because we have money in the bank doesn't mean we're going to go out and spend it just to spend it. We think that's the wrong way to do it. We haven't done it in the past, and because of that we think we've been successful. We've been successful. We'll continue to look for these deals. We'll find them. It takes a little bit longer, but this way it doesn't put us into the category of 4 or 5 other groups that have been out there that are all liquidating now, doing exactly what we don't want to do. So we just keep searching like we did in California and like we did here for the grow. It's been successful for us and for our investors. We're going to continue down that path.